Welcome, welcome, welcome all. I appreciate you being here. And let me just ask you this question. What if retirement isn't the finish line? It's the riskiest part of the journey. Today, I have Erik Brenner, who is a 30-year financial veteran who's helped thousands of clients navigate second half of wealth, how to safely come down the financial mountain. As CEO of Hilltop Wealth and Tech Solutions, Erik serves as personal CFO for successful individuals, integrating investment, tax, and legacy planning under one roof. Today, he is here to talk about why your parents' retirement won't work for you and what to do instead. Wow, Erik. I am so happy to have you because that's the big thing now with the baby boomers is the retirement.
Yeah, well, I'm glad to be here, Ida.
I'm glad to have you. So let's just get right into the nitty gritty. Why is climbing the mountain is easy, descending it is the real risk? Why is that a risk?
Well, when you think about the last, let's call it 30 years and, retirement, and so someone working in their working career, saving, investing, probably the generation, like my grandparents' generation, a lot of those had pensions, they had full
Mhm.
health benefits, and they knew that as long as they became vested, they could retire, have full pension, full health benefits, even if they were 60 years old. And
Right.
so when they retired, they made some decisions, but they took their pension, their healthcare was covered, and maybe they had a little savings and they were fine. Well, that has changed. Obviously, pensions have gone away. Very few people have pensions. Very few people carry health insurance into retirement once they leave what they're doing. Health benefits are over. And when they get into retirement, what happens is that journey, we call it down the mountain, can be treacherous because now they have to choose from when do they take their Social Security? Where do they take what investments when? What order do they take? How is it taxed? And so I often tell people, you could have 4 or 5 different income sources. All of them are taxed differently. And so coordinating that, can be a real challenge. And they're not one-time decisions where, again, grandparents' generation, it was a one-time decision. They chose their pension and that was it. Now they need to coordinate this on a year to year and during the year basis.
Wow. And that's a bit much for most.
It
This
is a bit much. Yeah. And, even though we do this is all we do it day in and day out. It's hard for us to keep up. There's been many, many major legislative and law changes just over the last few years. And so you have to keep up with it. And if you have a career on your own, I would say it's near impossible to keep up with all those changes.
Oh, you are so right because things are, especially now, um, things are changing. So, Erik, what is climbing the mountain? Talk about climbing the mountain is easy, but descending is the real risk. What does that mean?
Yeah, I would say, Ida, it might not be easy climbing the mountain. You have to be committed to savings and so forth. But if you think about your grandparents' generation, my grandparents' generation, they worked, obviously, they had their career. Many of those folks had pensions, and
Mhm.
they knew that if they worked for a company for so many years, they're vested. When they retired, they had full health benefits. Didn't matter when you retired, as long as you were fully vested, you chose your pension option, you had your health insurance, and away you go into retirement. Nowadays, that's not the case. Many do not have pension, or most do not have pensions. And so they have to save for themselves. They save in a retirement plan. They get a match along the way. So the companies give them a match. They get into retirement, and there is no health benefits for almost all that carry forward. So they have to make those decisions, especially if they're before Medicare age. And then coming down the mountain now, which means retirement, and then during retirement, they could have several different income streams, 4 or 5 that are taxed differently. You have some that are fully taxed, maybe some that are partially taxed, maybe some that are tax free. And that's a navigation that's a year to year basis,
Mm-hmm.
because chances are many people that are listening to the podcast, their biggest expense in retirement will not be healthcare, it will be tax.
Mm. Mm. And that's not what most people think.
That's what not most people think. As we see it and work with a lot of people in retirement, Medicare, along with good supplements, has really, really good coverage. People pay very little out of pocket, and tax is a bigger issue, and it will become bigger over the next decade, 2 decades, 3 decades, because people have assets now. They have assets that were saved in plans that have yet to be taxed.
Oh, yeah, yeah. Because it seems like, and one of the things that I always thought, and you can correct me, that when you get retirement age, like 70, what is it, whatever your retirement age, your 401k will be taxed in a different tax bracket. Is that true?
So maybe what you're talking about is when you have to take out from your qualified assets or IRAs, 401ks.
Yes,
So
yeah.
that age has changed over some tax legislation that's happened over the last few years. And so somebody that is born after 1960, that required age is 75 now. Somebody prior to that, then it would be sooner, up at age 73. And many people are drawing it now. When you have to take that money out, whether you need it or not, it is not at a different tax rate. It comes in to your taxable situation, just like other income that is of ordinary income. And
Mm-hmm.
that can push people to other tax brackets that they're not aware of.
Oh, okay, okay, okay. All right. So you just explained the tax situation, um, being the biggest threat in retirement. And wow, that's definitely huge, to say the least, because a lot of people don't think that way. So, how does the family office model be, become accessible to us?
Yeah. So the family office and strategy and model has been around for a long time for the ultra wealthy. So the ultra wealthy, many years ago, saw the need that they need to have a team working with them that's really looking at all aspects financial, and that includes taxes. And so what we saw is that type of model we felt was needed for more middle income America
Mhm.
because of the complexities that has happened, and continues to happen.
Yeah.
And so we call it being a chief financial officer for a client, or a CFO. We want to be a CFO for our client, so that from the simple questions on buying or leasing a car to the big questions of retirement, we want to be a resource that's an independent. We don't get paid commissions, and we can talk about our structure, but someone that's on their side in making all of these decisions. And then we saw the need to wrap in the tax and tax advice. Many advisors say they do tax planning, but they
Mhm.
really are not allowed to be able to dive deep. We have a whole tax division. We don't hide behind taxes. Taxes is real, and we take it seriously. As I said, it could be the most expensive or the most cost in someone's retirement. And so we want to help people through that from a tax perspective, from tax planning to even tax mitigation.
Mhm.
So that's how we bring the family office into how we work with folks. And we say, look, we want to be your chief financial officer and guide you along your financial journey.
Yes, and that's important because as you age, and not only that, if that's not your lane, you don't have a clue.
That's correct. And like I said, there's been some major legislation just in the last few years, and we have hard time full time in it doing it to keep up. And so somebody that, is in a career or even retired, it takes a lot to kind of understand it and make sure that you're doing what's best for yourself.
Okay, so I mean, I guess we all living in the world today, and we see all of the different legislature and all that kind of stuff that's happening. So I'm sure you guys, your tax department and all of your people are constantly involved with the different changes. So can you kind of bring us to right now what changes you've seen thus far?
So I'll take us back to 2020. 2020, there was a large piece of retirement legislation called the Secure Act that came out. The Secure Act was the biggest piece of retirement legislation in more than a decade, and it
Mm-hmm.
changed the way that your IRA money, your retirement money, when do you take it out? It changed the way that you need to think about it. It changed the way that your beneficiaries will receive the money. So often what we do is it may not be in this year from a tax impact, but it could be in 3, 4, 5, 6 years. That's the projection.
Mm.
So we had the Secure Act. We then in 2023, Secure Act 2.0 came out, even though there were some of the laws that we still weren't clear on from 2020. Now we have 2.0 in 2023. That, in addition, added complexity and the importance that we feel in planning. And then come this year, of course, the tax laws that were just signed. So those are more relevant as far as tax brackets, right? Itemized deductions, things of this nature
Mm.
that will affect people or may affect people. So when you kind of combine all that, it's here and now, 2025. How does it affect you? And then also going forward, how does it affect you? All
Yeah.
those things combined is what's important.
Yes, yes. So if clients want to work with you, how do they connect with you?
Yeah. So obviously, our website is the best place. I actually wrote a book. It's called The Personal CFO Guide to Your Financial Journey, talking about and navigating these things. And they can go to hilltopwealthtax.com/podcast. That's hilltopwealthtax.com/podcast. And they can get a free copy of the book.
Uh-huh.
If they have an interest, we set up 15-minute introductory calls, allows us to find out a bit more about the client. You find out about the firm and really see if there may be a possibility. And if there is, we can match them up with a wealth advisor. But the book's a great thing, I think. And I've been told that it really helps people think about it, not just this year. It helps them think about their transition and guiding down this mountain. Do you realize that? I think this is an interesting statistic that 80% plus of all mountain climbing fatalities happen on the way down.
Wow.
They don't happen on the way up. Well, why is that? Maybe they don't have a good guide. Maybe they slip on a rock, right? Maybe
Mm-hmm.
they run in, they don't take the right path down. So we think about it in what we do is we help people guide, we're your guide down the mountain and making sure that, you are making the right decisions. In retirement, what you're making in gross income's one thing, what you're actually putting in your pocket net is a whole different.
Yes. Yes. And that started from the very first job.
Exactly.
So we know we don't get it all. Wow. I'm excited about the book that we can get for free because that's really important. And not only that, like you said, it gets people thinking. And
That
that's
is
what you
correct.
want. You want people
Yep.
to think. Wow. So let's talk a little bit about the costly blind spots of high income earners and how to avoid them.
So a couple things I think about. One is when they're saving and they're higher income earners, are they saving in the right places? So
Mm.
an example, simple example is putting into a retirement plan through workplace that you're able to deduct today. So it feels good because you're in a higher tax bracket. And 25 years ago, we would talk about you're going to be in a lower tax bracket in retirement. And that may not be the case.
Yeah.
So saving in a pre-tax, you're saving it today. Well, if you're saving it today, that means you're deferring it. That means that at some point, tax is going to be due.
Mm-hmm.
And we don't know what the tax brackets are going to be 20 years from now. I mean, no one knows. What I know is we are in a 40 plus year low as it relates to the tax brackets. And
Mm-hmm.
so most people think they're probably going to go up at some point. So where do you save it? It's not just put it somewhere. How do you save it?
Mm-hmm.
Then another kind of roadblock, and that a lot of people don't realize, is there is differences in the planning, particularly tax. There's tax deferral, which is deferring the tax owed till some point in the future. There's tax mitigation. Tax mitigation means you eliminate the tax in the year you're in and you don't owe it back at all.
Mm-hmm.
So there are strategies that have been utilized by the ultra wealthy within the family office environment for decades. And there's multiple strategies that can mitigate tax. And so that means bring down what you owe this year. So we do a lot of planning, tax strategy, and mitigation. And how does that all work into the overall financial plan? And what we're able to do, since we're an independent fiduciary firm and we have the tax business as well that's integrated, we're able to take that from step one all the way through and then help people every year along the way.
Wow, that's amazing. I like that. Now, let me ask you, do you do anything with trusts?
We do. So we do estate planning for clients. We'll help clients, just kind of bug them to do an estate plan. We see a lot of people that come to us new, and even our current clients, some of them, you got to get an estate plan. We see a lot of clients that come to us initially and they don't have an estate plan at all. So we'll help them with that. And then we have the capability through some of our partners in making sure that all those documents get done. Do you need a trust or not? What happens with your estate, right? Also title. So getting the documents done and your estate plan done, that's a step. That does not mean you're done. You want to make sure things are titled properly, your assets are titled properly to make sure that they're passing the most efficient. And that's really what that's about. Estate planning is about making sure that you're taken care of.
Mm-hmm.
Also, if you're incapacitated, it doesn't necessarily mean you have to pass away. But if you cannot take care of your finances or your health, making sure you have somebody that will designate to do that. But then once you pass away, you have two choices where it goes. You can leave it to the ones you love, the charities you care about, or you can leave it to the IRS.
Nobody wants to do that.
Nobody wants to do that. I've never seen in 32 years of doing this, I've never seen the IRS as a beneficiary.
No.
So we help people also in that aspect to make sure that it gets passed along, properly.
Yeah, because that's a big thing, especially in the retirement age, because most retirees have homes, and that probate thing is a bear.
It's
And
a bear, and a lot of people will have two homes in different states.
yes.
So, which complicates it.
Mm-hmm.
So probate is, yeah, if you can minimize or avoid it most of the time, that is the best, because otherwise there's just costs that your estate would not have had to pay.
Right, exactly, exactly. Wow. So waiting to plan your exit, how can that cost you?
Well, what can happen is that if you don't have a good plan in place and you're looking ahead and you're not looking ahead, well, then what can cost you is you now have savings and you might look at your overall savings and what you have saved and you have enough. But, okay, it might be in the wrong positioning or not quite in the best positioning for yourself when you go to take it out.
Mm-hmm.
So, therefore, that's why I mentioned the taxes. So, one of the things I share with people is, I could have two different couples that are retired that each have $100,000 a year in retirement income. One couple has 20,000 in tax, 80,000 net. That's their take home.
Mhm.
I could have another couple that also has $100,000 of gross income and have zero in tax, and they take home 100. Both of them, if we're asked and they shared, willing to share, say, I have $100,000 of income. What's your take home? That take home can swing drastically. And it swings because it was not planned for, their exit strategy, and during their retirement wasn't properly planned for.
Wow. And when should you start planning?
Well, really, you should start early, right? When you're young, you want to start early. You want to start putting away. One of the questions we get a lot from younger folks is, how much should I put in Roth compared to traditional deductible?
Mhm.
Roth, you don't get to deduct it today, but as it grows, it's tax deferred. When you take it out, it's all tax free. We really like tax free. Tax free is around, it's going to be around. Okay. The law and what they've done in some of the laws, they have stated basically with the changes, we love tax free. Why? Because they get the money today, because you're not saving it. They get their tax money today. So early on, it's important. But then for retirement, you want to have a savings pattern. But really, once you get into typically people into their early 50s, later 40s, then you really need to start looking at projections. What's going on? How is it going on? What's going to be? What's the income streams going to be? Those kinds of things, so that you're not 1 year out, 2 years out.
Okay. Now, what if you already there? How do we correct that mistakes? Let's put it that way.
The question, yeah. So if you're already there, that's okay. You still can make shifts, changes, and so forth. It's just a different way of approaching it. But I
Mm.
wouldn't look at it as too late. The other thing is that longevity, right? People are living longer. I mean, the
Yeah.
average life expectancy, people are living longer. So it's not something where someone retires and, hopefully, they only have 2 or 3 years. So just because you're in retirement doesn't mean that it's too late.
Okay, good, good. Because I know some people may be listening to this and like, I'm already retired. Will this work for me? You know what I'm saying? What can I do? How do I know? At least have somebody to look at what
Right.
they're currently working with
Yeah.
and direct them to the best plan for them. Yes, yes, indeed. Wow, this is amazing, Eric. I've learned a lot about, you know, you done broke some myths for me in terms of the taxes because I always thought that, and I think I've read that somewhere, but you just dismantled it, that when you become a certain age, you automatically fall in a certain tax bracket. But I can see that there's a lot of variables attached to that.
That's correct. Yeah, the brackets don't change whether you're working or not. If you're married filing jointly, the brackets are the same.
Mm-hmm.
So that doesn't change for folks. And therefore, as we're talking about with the different streams of income and how they're taxed, that's where it really comes in and really matters.
Yes, yes. So, yeah, so from burnout to balance. And you've explained that so eloquently, but let's just sum it up, in terms of having wealth strategy for the long haul, just in a
Yeah,
nutshell.
if I would sum it up, a couple things. One is that if you're in planning, so if the listeners are in the planning mode and they're a few years off, you want to have a game plan on, do you have enough? Have a goal. When do you want to retire? Do you have enough assets? And then the second piece of that is it in the right positioning? You want to have that. Is it in the right positioning? And then as they get closer, right, it's a continuation of, is it in the right positioning? Is there anything we can do? Obviously, there will be changes in the future. We've had tax law changes over the last few years. So that'll continue to adapt and change. And then as you get into retirement, then it's a matter of where does it come from and what's the most efficient and those kinds of things.
Okay. Now, with all of the changes that have happened to Medicare, uh, do you keep, what's the word I'm looking for? Do you keep up on that as well?
Yeah, we do. We do certainly help people with Medicare. We don't sell Medicare. We don't sell Medicare supplements,
Right.
but we do have partners that we work with that specialize in that. That has gotten to a point with the supplements that it needs a specialist because they need to
Yeah.
keep up with what's changing and so forth. But what we do provide is we provide that again. We're there for them. We're there for the client that they can, when they're in the selection mode, they can help, we can help them through it. What are the decisions you need to think about based on your situation? So we help them with that and get things set up. The other thing about Medicare is people have to be careful of a thing called IRMA. IRMA is when you make more money, uh, there are thresholds that once you reach a threshold in income in retirement, you will pay more on your Medicare. So you pay more than what your stated rates are. And so I can tell you that folks don't like paying IRMA. And
Sure.
so that can sneak in on you. The other thing that is really important nowadays is Social Security and Social Security timing. So I always say it's not grandma's Social Security anymore, meaning it's not $900 a month typically. If people have been working, if both are working, if they're married and have a spouse and they're both working, it can be substantial. And
Mhm.
so it is a huge decision, and it's really a pension. So even though pensions have gone away for most, almost all people have Social Security. Well, guess what? You have a pension.
Yes.
So deciding when to take it, again, if you have a spouse, when they should take and you take, coordinating all of that benefit, we find people find it helpful. And again, it matters on these income streams.
Yes, because all of this stuff is so confusing. Even the application is confusing. So the whole, I don't know why they make it like that, but they do. But
They
it's
do.
all, yeah, it's just what, so so having somebody that can help you through your finances is probably the smartest thing anyone can do, because most people don't understand the language. And I know, unless you're in the tax industry, you definitely don't understand that.
That's correct. And I think there's two things to think about with that, the tax. There's preparation, which is
Mhm,
taking the numbers that are reported, right, and putting them in the proper place on your tax forms, what
mhm,
tax forms you need to file and all of that. Okay. Then there's planning. So unfortunately, a lot of preparers, CPAs, tax professionals, they can do the preparation side and they understand that, what forms changed and so forth. What really comes in and people are missing is the planning piece.
mhm. Yes, and the people that work in your office, are they like tax attorneys? What are they?
Yeah, so we have advisors, wealth advisors, and they have professional designations in the industry. And then we also on the tax side have enrolled agents, we have CPAs, and we even engage in a CPA firm that we work with very closely when we have high net worth, high income on
Mm-hmm.
multiple strategies. That's all they do. So there, we consider them on our team. All they do is mitigation tax strategies. And
Mm-hmm.
so we work with them closely to come up with a tax plan for that particular individual. And typically that's not a one time a year, right? Or once in a lifetime. It's every year. Let's work through a tax plan and make sure that you're not paying more than your fair share.
Yes, yes. So you have a whole, like you said, a team of experts.
We do. And we lined up a team and we have a team in, supporting us. And that's really the family office, the CFO, how we go about it. We're here to make sure that everything gets coordinated.
Yes, and that's perfect. So again, how do clients connect with you and get that book?
Yeah, they get the book by going to hilltopwealthtax.com/podcast. That's hilltopwealthtax.com/podcast. They can grab a free copy of the book. They can also grab a 15-minute uh, consultation with one of our team members. They'll find out more about you, find out more about the firm, and see if it even makes sense to have a conversation. And we would be glad to talk to somebody if they've got additional questions.
Yes. So Eric, I mean, you have really dropped some gems today. And I know my audience is really, really happy about this because this is important stuff. This is your money. This is what you worked for all of your life. And you want to really, when you're at that place, well, before you get to that place, you want to make sure when it's time for you to retire, it's right.
Yeah, I think you summed it up. It's very important. I mean, typically we see next to your health, someone's health, money, whether they need a lot or they don't need as much, it is important because we're as Americans are more responsible for ourselves now than ever.
Yes.
And
Yeah,
so we have to go through and sift through all of this information and make sure that it fits for your particular situation.
absolutely. Well, I definitely appreciate you, Eric, taking time out to share all this good stuff with us. And we have definitely have to do this again because I believe that people need to hear stuff more than one time. So we should definitely plan on another collaboration. And audience, we want to thank you as well for tuning in. So Eric, thank you so much.
Thank you for having me.
Absolutely.